What's up, everybody, and welcome back to the channel. I'm sure many of you are aware of the hundreds of stocks that you can choose from when you invest in the stock market. That makes it all the harder when you're trying to choose just one. As always, investing in the stock market can be risky because you can lose money. This video, I speak about my experiences with my investments. So if you follow anything in this video or any video that you see online, you do so at your own risk. For some people, investing in just one company can be very risky. So for those people, an ETF may be the way to go, as it involves investing in a pool of companies instead of just one. Yes, there are companies that you can buy and hold on to for a couple of months or even a couple of minutes, which would be considered day trading. I've been down that road before and I'll make another video about it. It can be profitable, but what about those people that don't want to lose sleep? They just want to kind of invest in something and forget about it. Well, today I'm making this video to review the top 3 ETFs that a person can buy and just hold it forever. Just 3 ETFs seems way too simple and too good to be true. But I've been using this same 3 ETF portfolio for years, and I can confidently say it's beaten any other 3 ETF portfolio that I've seen, and it's definitely beaten the stock market by itself. ETFs are basically a cheat code. Instead of having to figure out which company to buy and when to sell it because it's dying, the ETF does all the work for you. But enough talking, let's get on with the first ETF, the Vanguard Total Stock Market Fund, ticker symbol VTI. Since it's an index fund for the total market, it has over 3,500 companies spread over different sectors. This fund invests largely in large cap, mid cap, and small cap stock, including value and growth companies. It's sort of the American melting pot to provide a broad exposure. This is the foundational ETF. This is where everyone should start, in my opinion. If you were to have just one fund and your entire portfolio consisted of just that one ETF, this is the one ETF I would go with. This one is all about safety and consistency. Even though this ETF is spread across so many sectors, it is a little bit heavy on technology, but then it balances out on consumer discretionary, industrial, and healthcare. It should be no surprise that the top held company in this ETF is Apple, but at least it's not over the 10% mark. As for performance, VTI is trading at $300.26 and has a year-to-date return of 28%, meaning if you had invested $100,000 at the beginning of this year, you would be sitting at $128,000. Not too shabby. Over the past 12 months, this ETF has returned 33%. And over the past 5 years, this ETF has returned 89%. And if you look over the last 10 years, this ETF has returned 186%, which means that if you had invested $100,000 10 years ago, your investment would now be worth $286,000. Not too bad. One of the best parts about this fund is you're only paying 0.03% as an expense ratio, which means that for every 10K invested, you're paying $3. And if you invested 100K, you're still only paying $30. This is a lot lower than going to a financial advisor and paying them a whole entire 1%. Out of 100K, that's $1,000 every year you're paying. Now, I don't advise every single person out there to just self-direct all their investments. Sometimes it is a good idea to go and get a financial advisor, but it's just not for everybody. For VTI, the diversity is great. The expense ratio is extremely low, and it's the American melting pot of great, diverse companies. Which brings us to our next ETF, the Schwab US Dividend Equity ETF, SCHD. I had to include one of the best performing dividend ETFs because it balances out everyone's portfolio and gives that great option of the dividend, which is excellent. It not only has seen overall share price growth, but it's also seen its dividend increase yearly, which means that you buy in at a certain price and you get a certain dividend. But just by holding that dividend ETF each year, not only does the share price go up, but the dividend as well. I love that the fund managers are very picky on what they include and don't include in this fund. They look at things like cash flow to debt ratio, return on expenses, and dividend yield, of course. The goal of this ETF is really to invest in companies with at least a 10-year history and consistently paying out good dividends. They make it a point to have healthy companies and not just invest in those companies that are really dividend traps that are pushing a high dividend for a falling company. We've all heard of those companies that offer high dividends into the 15 to 20% range. And we have seen that they're just really needing an influx of investors in order not to file bankruptcy. I also like that they cap out the investment in any one company to just 4% of the total fund. Not just that, but no one sector can be invested in more than 25% of the total fund. That diversification is there, which helps to make sure that they don't get lopsided into one particular share or one particular sector. The top 10 stocks are high quality companies like Verizon, UPS, and even Home Depot. This is the ETF to invest in for optimal safety. Not only that, it gives optimal dividends every single quarter. Really, you could live off that cash flow and never have to touch those investments and pass it down to children or grandchildren as an extra blessing. SCHD is fairly well known and it's trading at $29.58 a share and has a year to date of 17%. Meaning if you would have invested $100K in January 1st of this year, your investment would be sitting at $117,000. Over the past 12 months, the share price has returned 23%. Over the past 5 years, it's returned 55%. And over the past 10 years, it's returned 119%, meaning a $100,000 investment 10 years ago, you'd be sitting at $219,000. Nice to see that the expense ratio is incredibly low on this one, sitting at just 0.06%, meaning every 10K invested, it would only cost you $6 to do so. For the young people that clicked on this video, and even the people that are not so young and just trying to get their investments in order, this simple 3 ETF portfolio is the simplest way to reach wealth without the hassle of picking stocks every day or day trading every day and just choosing from long-term investments. That's why I made this video, because I know it's not always what you thought it would be or what you had in mind. Which brings us to our last fund, the Invesco QQQ Trust, aka QQQ, which tracks the NASDAQ 100 itself. The NASDAQ 100 is the largest 100 companies that lean heavily into technology and innovation, which makes up 50% of the fund. You could say it's the Mona Lisa of growth ETFs. It's the most recognizable, it's the most talked about ETF, and it's probably the most studied ETF in the world. It's the highest rated large cap growth fund by total return over the past 15 years. It's the second most traded ETF in the country, second only to SPY, and really is no surprise because it has a 5-star Morningstar rating. It has a 15-year history of performance against the S&P 500, which has basically crushed it. When you look at the top 10 holdings, it's similar to what you might see in other technology ETFs. In the top 10 companies, you see companies like Microsoft, Nvidia, Apple. Now, this ETF is different from the first two that I've mentioned because this ETF is not diverse at all. But it is focused on high growth because it's focused on high-tech companies. That means that the positive years will be great, but the bad years will be downright horrible, which just means that when you invest in this ETF, you need to have high conviction, because if you can stick it out through the lows, you can come out on the other side very wealthy. Because of this high emphasis on technology, it happens to be one of the highest highs and the lowest lows. But obviously the good outweighs the bad, and I do not regret at all investing in this QQQ. When you balance it out over time, there is no doubt this is a great performer. QQQ is trading at $510.09 and has a year-to-date return of 26%, which means if you had invested $100K in January 1st, you'd be sitting at $126,000 right now. Over the past 12 months, it's returned 32%. Over the past 5 years, it's returned 149%. And get this, over the past 10 years, QQQ has returned 386%, which means if you had invested just $100K 10 years ago, your investment would now be worth $486,000. The expense ratio on this bad boy is 0.2%, which is a bit higher than the first two at $20 cost for every 10K invested. Still a lot lower than a lot of funds out there. I'm not sure if you can tell, but I really like this fund. And with artificial intelligence blowing up over the next several years, I expect this fund to do very well over the next decade or two. It may not be the best in any one thing, and also it may not have the best return every single year because it's going to cycle through sectors, but it gives you amazing returns in a diversified way. Because as the macro environment changes and the companies change, you have an amazing chance at continuing that great performance because QQQ is not tied down to any one sector. With all that being said, the market will always go up and down. There's always going to be bad news and there's always going to be good news. The people who earn the most amount of money and really have compound interest work for them over the long term truly are the ones who don't ever touch their investments and just let it ride. I always recommend buying these things and holding on for as long as possible because the stock market tends to act sometimes like a 3-year-old just having temper tantrums. But those are short-lived tantrums because over the long run, the chances of you doubling, tripling, even quadrupling your money greatly increases. As always, investing in the stock market can be risky because you can lose money. I hope you guys enjoyed this video. If you did, smash that like button. And if you're new, go ahead and subscribe so you can see the latest content as soon as it comes out. We'll see you guys on the next one.
Sway.